Hello, and welcome back to Monday Morning Trader, the show designed to help you supplement your income. Today, April 2nd, 2020, we are going to look at an article I found on Kiplinger. It was detailing 19 dividend aristocrats who are on kind of a good sale right now with all of the downturn in the market. So we're going to take a look at a few of those that I highlighted that I think are specifically good deals. First of all, I think it's important to realize what is a dividend aristocrat. Well, that is classified as companies that have had their dividend raised at least 25 consecutive years. Many of the companies we're going to look at have been much, much, much longer than that. But basically, it's showing you stability in a company and the ability to get a dividend, a quarterly payment, basically consistently every year, and not only that, but that payment will go up. During the 2010s, which obviously just ended that decade, return for companies that were classified as dividend aristocrats was 14.75%, which was about 2% or so higher than the S&P as a whole. Dividends probably account for about 30% of the returns typically in the S&P, so dividends they're a good thing, especially for retirement income and things like that. Dividends also make that stock less volatile. Being able to provide dividends reliably means that you have a bunch of free cash flow. So hopefully that means that your company is not going to have quite the price fluctuation that it is normally. Earlier I read that it's about a 9% less volatility rate than normal stocks. And basically with everything going on right now, there's some good looking discounts right now for some of these stocks. And the thing about this is typically for Monday Morning Trader, we're looking at ways that we can get a weekly income, weekly paycheck with writing some options. This is more if you had a big chunk of money that you'd want to invest right away in one fell swoop, just because you can kind of lock in some pretty good dividend yields right now that you can't typically get something that looks quite this good. So let's take a look at these. First one's Walgreens. We're going to look at the price at the end of the first quarter, so the end of March, and then the top of the market right now was on February 19th, so we're going to see how far it falls for each one of these, and then kind of what its current yield is for this dividend. So the price was a little over $75. It's dropped 13.3%, which is not a lot in comparison with some other companies out there. Dividend $1.83. That puts the yield right now at 4.1%. Again, to me, anything over 4%, you're looking at a pretty good deal there. Walgreens hasn't fallen as much as other, like I said before, because it's still pretty popular, still pretty busy. It's still obviously needed to fill prescriptions. Healthcare products are in high demand right now, so Walgreens is still getting a bunch of sales. It is an essential business, so it stays open. So again, I don't think it's going to get hurt as much as some of these other places. Dividend has been raised for 44 consecutive years, and only 44% of its profits go to dividend payment, which means that dividend payment is pretty secure, pretty safe when only that much is going to it. Obviously, Walgreens, you see them everywhere. I've been to Las Vegas, and I swear there's one every other block. So this is a company that's very safe, very solid, and I think this is a really good play right there. Next one's Johnson & Johnson, $133 and a penny at the end of the first quarter. Down again, not as much as other companies, just over 10%. Dividend of $3.80, 2.9%, not as maybe attractive as a 4% one, but 2.9% is still pretty solid, more than you're going to get putting into a savings account or anything like that. Big thing for them is their stock could pop pretty big here. They just got announced that they're working on a COVID-19 vaccine. They actually got a big grant from the government. So if they're able to come up with one, I think it was $1 billion or I guess enough money to be able to produce 1 billion of these vaccines if they are necessary. So that would be obviously a catalyst to get their stock price to go up. 57 consecutive years of a dividend raise for them and not a lot of debt. So they are pretty safe company. Again, Johnson & Johnson, a bunch of healthcare products, baby products, things like that, things that need to be bought no matter the state of the economy. Third one, Genuine Parts, GPC, $66.08 at the end of the first quarter, down over 33%. So this is one of those that's dropped a lot. Dividend of $3.16, current yield 4.8%, so super attractive there. Has 5,900 Napa stores in 44 states. I was not aware that this was Napa's company ticker symbol there. But again, Napa stores are found all over the place, 5,900 of them. That's a lot in almost every state. 64 consecutive payments, not years, but payments. The dividend has raised, so that's looking still at 16 consecutive years or so that the payments have gone up each and every time. And again, dividend payouts less than 60% of cash flow, so they're getting enough cash in still, even with the downturn there. They have enough cash on hand to be able to pay out dividends. Listen, people are still going to be driving. Now, not as much with the current situation. People have to stay at home. But there's still going to be car repairs. You're still going to have issues, oil changes, all that stuff. So I still think automotive areas, automotive repair shops, automotive supply companies, they're still a good spot to have some money and some performance here. So I think GPC is a decent look here going forward. McDonald's, we all know about them, $168.13, down 22%. I was surprised to see it down that much. Dividend right at $5. That puts it at a yield right at 3%. 100 countries, over 100 countries, over 38,000 locations. Ton of McDonald's out there. Now, still staying open. It's fast. It's drive-through only right now, which is going to hurt some of their sales, obviously. So it's not going to be quite as much as it has been in the past, but still, I don't foresee them dropping a ton because people are still eating. There is kind of a push right now for helping out the mom and pop restaurants, but I still think for convenience factor, McDonald's is still going to stay really busy. 43 consecutive years that dividend is raised. Free cash flow over $5.7 billion last year, so they have plenty of money there to kind of fund the dividend to pay out to people. So again, once this thing's over, McDonald's is going to still be around, going to still be super busy. I think it said that they serve 70 billion people a day from all their different restaurants, or at least that was their average before this whole thing. So I don't see this being a long-term downtrend for them. Next one, Emerson Electric. Not as popular of a name as the other ones, really. Price $46.63, down over 35%. Dividend right at $2, 4.3% yield, which again, pretty attractive there. They make a bunch of different automated solutions in a variety of different areas, heating and cooling, some computer technology. So again, stuff that you have in place that if it breaks, you're going to want it fixed. So they're going to be pretty solid in terms of getting business still. 63 consecutive years. That is so long there for the dividend having been raised consecutively. Unbelievable to me that it's been around that long and that it's done that well. And the dividend payout's only about half of its free cash flow. So they got plenty of cash and reserves there to be able to kind of keep it going. A stock that does not cost a lot there in comparison with some other ones, getting a 4.3% yield. It seems like a pretty good deal to me. So these are just 5 of them. Again, this is an article from Kiplinger. If you're interested, I'm sure you can find it there. But this is one of those things. If you have a bunch of money, sticking it in one of these right now, or maybe spreading it out to diversify, I think it'd be a good thing, because when this downturn is over, these are all going to snap back, and you're going to lock in these low yield rates. Especially if you're nearing retirement, want that kind of constant cash flow coming in. This is a good way to do it. All right, that'll do it for today. Check back on Friday to see how the weekly covered call pick that we had on Monday has fared and what our return was. So far, looking like we're going to finish in the green. That's the main thing. Remember to subscribe. Hit that subscribe button so we can keep bringing this show to you. Happy trading. Remember, stay green, not greedy.